Perfect, perfect. Allow me to start the recording. The rest of the people will join in. I would want to welcome you for this session. Okay, I'm disabling the texts and everything. Yes, Prim is finally here. Allow us. Can we hear you right now, Prim?
Am I clear? Can you hear me better now?
Yep.
Okay. Hi everyone. It's so good to have you. This class was as a result of me asking Alex to explain my will statement. I think Alex, this is one of the things you'll explain later. To explain my will statement to me because I saw a negative there. And I bought a bond. For pretext, I bought a bond last year at the beginning. And each time they paid out, Alex, you're going to be embarrassed. I was eating that money. I kept asking myself, who is surprising me with money in my Standard Chartered account? So I would happily go shopping or happily swipe that card somewhere. Then after eating this the second time, I noticed that money was coming after an interval of 6 months, and that's when I realized that was my payout. I promised myself that when the payouts come, I'll reinvest them in something else, like maybe journal or reinvest generally. But I hadn't invested because I was eating the money from ignorance. So when I realized that I had a problem, I reached out to Alex and told him I need someone to explain this. Yes, I had bought bonds, but I didn't have enough explanations as to what I was buying. I just bought because of it's what I could do with my money at the time. So when I reached out, I told Alex that I may not be alone. I have an Instagram community that must be going through the same thing. And I told him, what if we had a class for people who are like me to learn? And a lot of people had been asking me before about bonds, and I just didn't have the answers. I'm very glad that Alex said yes. Alex is Alex is an investment and finance analyst with a strong focus on Uganda's capital market, with over 7 years of experience in the financial services. He writes about the latest finance developments as well as his own investment ideas. And you can subscribe to his newsletter. I'm hoping that Alex, everyone whose email you have, will be added to Alex's Substack, and they will also gain the same knowledge that I have gained from you, me and many other people over the years. So without further ado, Alex, welcome. And yeah, let's take it away.
Thank you so much, Prim. Thank you so much for this ideation, and I hope everyone can hear me. It's going to be extremely interactive. At any one point, if you need the clarifications, you can post the questions in the chat. I'll address them. It's over 2 hours. It's going to be a little bit longer depending on how we interact, but I hope you take something from here. And I'm going to start right away in why we are trying to focus on treasury bonds, why we are trying to focus on treasury bills, and what it means for you who is trying to invest in these. So there is one thing that we need to take a step back for me as I go through this conversation is in the previous years, we have always had a conversation about investments, about finance, about money that dealt with mostly real estate. Capital markets is a starting concept in Uganda. It has been there for mostly 10 years plus, but it's just starting to pick up. And all of a sudden, we are starting to tell people, hey, there is this new kind of investments you can make no matter where you are, no matter how much money you have, and take advantage of that. That's not to say you cannot invest in any other things. You can plan using treasury bonds. You can plan using treasury bills, what you're going to go through. We're going to talk about emergency funding and investment investment strategies that you can use for your treasury bonds. We're going to talk about things like a little bit of some stocks and ETFs, because we have our friends who are in the international markets that can access those. And by the time we are done for the 2 hours, you should be in position to kind of take a step back and be like, what is my takeaway? Can I now take an advantage of the bond? Can I select the right bond for me? And what are the risks that I need to consider before I kind of make an investment in the treasury bonds? So these are our key learning objectives today. At any point, if you have any other questions that you'd want to kind of understand, you can drop it in the chat and we are going to go through it. But the first thing which I thought we should talk about is when it comes to treasury bonds, they are not new. The treasury bonds and treasury bills, they are not new in Uganda. Not at all. The first treasury bill or security was issued in 1969. Yes, for those of us who are familiar with the Uganda's history, I believe that was Obote 1. And since then, every single year, there has been an issuance of a treasury bill or a treasury bond for the last plus 40 plus years. And at this point, I want also to indicate that for all those 40 plus years, there has never been a default in Uganda, where we shall talk about the defaults and what that means for you as an investor. But what I'm trying to bring out to you is that this is not something new. Those who knew about it in the 80s and the 90s, they invested. Now, some of us who are getting to know about it right now, we are starting to invest. But then you have to sit back and say, what is everything that I need to know about treasury bonds and the treasury bills? And how do I take advantage of this? How do I incorporate this in my finance? Right? And everything starts with the goal that you want to set up for you as a person. And I made a survey. Majority of us are trying to set up an extra income, financial independence. 90% of us are fully reliant on our salaries as our major source of income. Now, all of a sudden, we are starting to tell people that is no longer enough. And I know for Prim, she took the bold decision last year and she started investing in the treasury bonds. But it's not just about investing, it's about why you are even investing. To say, maybe in 5 years from now, I need to have 2 streams of income. The same way you might be employed or self-employed, or you have a business that you are running and it's bringing in money and you have an investment component into that. It's the same way you can set up treasury bonds and treasury bills to be a business for you that brings in money. The same way you can set up a business and say in 10 years from now, I would want my shop, maybe which is selling maybe cosmetics, to say in 10 years, it should be bringing in revenue of 10 million a month. In 5 years from now, you should kind of have the same targets and goals for the treasury bills and the treasury bonds. And when you set it up clearly, then you will know why you should buy the treasury bond and which treasury bond you should buy and where you should buy it from. So it's not just a matter of saying, okay, I need to be in a position to say, let me try this out. Do not come into the treasury bond to try it out. When you understand where the actual concepts are and where to make the money, especially the long-term view, then you will automatically see the benefit of that. And understanding the separation between the treasury bills, treasury bonds, short-term and long-term, it's where we're going to start from. Now, I'm presenting the current calendar to explain what is a treasury bill and what is a treasury bond. And does that easily incorporate into your investment strategy? Now, I'll start with the treasury bill. Treasury bills is the brother of a treasury bond. The only difference is the treasury bills mature in less than 1 year. That's why you see they can be 91 days, 122 days, 182 days, or 364 days. Treasury bills mature in less than 1 year. For anyone who is investing in this type of product, when you go to your bank and you want to buy a treasury bill, you have to ask yourself, do I need to even buy the treasury bill? What is the alternative that is there? But for as long as you're trying to invest for less than 1 year and you want to buy something that matures in 6 months, right now we are in March. Chances are you have plans next by December, and you need to put some of the money you have right now for 12 months or 9 months or 6 months. That would be the treasury bill for you. But the question is it a good treasury bill? Now, I know one of the questions people ask is how do I, and we go back to the step back, the first objectives, how do I make the right investment strategy, the right investment decision? So we are starting with the treasury bill. We're going to break it down. I'm presenting two things. You will confirm if you are seeing I'm presenting a PDF. Confirm that you are seeing Bank of Uganda Central Securities Depository. Just type in for me to make sure that you are seeing it. Perfect. Thank you so much. So this is how a treasury bill works, and that's how it will look like. And I want us to go through something here to understand it and then to drive the point down in terms of what is the decision you have to make when it comes to the treasury bills. Treasury bills are sold at a discount. What does it mean? That if you are buying a treasury bill worth of 1 million, the government will sell it to you at, let's say, 860,000, which we are calling the cut-off price. So I'm going to be adding some commentary here. So this is, they are sold at a discount. So that means for them, the profit you make is between what is at a discount and the face value. Then the question becomes, what is the face value? And that's what we're going to talk about it more and more. The face value is the amount that they pay you when the bond or the bail has matured. In this case, after the 364. However, you have to appreciate that when it comes to the treasury bills, when you buy a treasury bill as an individual, it attracts a tax of 20% on the profits you make. And this is what makes treasury bills unattractive for so many people, or to basically say why I wouldn't recommend you to buy a treasury bill. And I know people here, some of you have them already, and some of you have been like, oh, I want to invest for just 1 year to try it out. Why don't I buy a treasury bill? It's about the numbers. In part of the first exhibit I sent is this exhibit. I know for those of you who managed to go through it, and we're going to go through it. I'm assessing what you are seeing in this PDF. This auction was a week ago, last week on 27th. So it's what we are assessing. So let's assume you had 10 million. You wanted to buy a face value of 7 million, of 10 million. It means you would have paid 8.6 million in cost. Now, I want to make this very clear. Let me add a line at the top. The cost is the amount you pay. The face value is the amount you receive at period end. The amount cost is the amount you pay. That's the money you should have on your bank account. And the amount you receive is after 364 days. That's the amount you pay. That's what we are calling the face value. So that's why we are calling the treasury bonds are sold at a discount, is to say if you are buying for 10 million, they're going to charge you 8.6 million. That's when you're going to end up having a price of 86.988, which we are seeing here. And that is for the 364 days treasury bill. And someone would be like, okay, if I'm buying a bond, a treasury bill of 10 million and I'm paying 8.6, how much am I making? That I'm making 1.3 million profits per year, right? For the 364 days, that's the profit you're going to make. If you are buying a 364 day, but we talked about that it has a 20% tax. When you have a 20% tax, they are going to tax this profit that you're going to make. Boom. So then you end up having a 20% tax. Then this is the amount that you're going to get, which means at the end of the year, this is the amount they are going to give you back. The 8.6, the what you gave to the Bank of Uganda, you invested in the treasury bill, plus the profit after tax of 1.04, which is the 9.7. And that means you are making a profit of, sorry, that means you are making a profit of around 12%. You invested 8.6, you made a profit of 1.04 after tax, and you're making a profit of 12% in the 1 year. So then you have to ask yourself, if I'm buying a treasury bill, is it worth, is the return that good? Do I need to hold the treasury bill for a long time to that extent? You know? Now, for 1 year, you can see it's that 12%, it's a good return. What about for 182 days? Let's come back to here. The 182 days, when you look at these interest rates, and I know it's the first confusion. Oh, sorry. I picked the wrong one. When you look at these interest rates for 182 and 192 days, these interest rates are 12% and 13.99, but you do not make all of it. Because the bond, the treasury bill you're going to buy is just 91 days, you make a quarter of it. When you buy a treasury bill of 182 days, it means you're going to make a half of the interest rate, which comes back to this. For a 182-day treasury bill, for 10 million, you're going to end up paying 9.3 million. Remember the amount you pay, what you get out of your bank, and you buy. Then after 6 months, you make a profit of 500,000. And the actual profits you're going to make is around 10.7. So you have to sit back and ask yourself, is it worth for me to just make a 10% profit? Or can I put my money somewhere else? It's at this point that I bring in the first investment advisory. Some people are saying they can't see my screen. Confirm if you can see an Excel. I'm presenting an Excel working. Okay, people are confirming that they can see it. If you can't see it or you can't hear me, I would request you drop out and join in. It might be an issue on your side. Thank you so much. Thanks so much for the guidance. So this brings me to the first investment advisory for the treasury bill. If you are to put your money in a unit trust, and I gave you a some of the documents I sent in a unit trust tracking, right? So let's assume we have two people. One person is like me, I want to buy a treasury bill for 1 year. They have their 8.6. After 1 year, this is the total amount they have. Then another person, we have Grace. Grace has bought the treasury bill. Then we have Prim. Prim says, me, let me take the same exact amount of money in a unit trust. When you take it to a unit trust, 8.6. Unit trust on average, they pay 11% per month, which is around 0.87 per month, right? So this is annual, this is the monthly. So after this, by December, the person who has gone to a unit trust, and you're going to be seeing these comparatives, has 9.6 million. But the person who has gone to a treasury bond, treasury bill, has 9.7 million. A difference of around 100K, I believe, if I'm to do this. No, it's actually 84K. Then the question becomes, you as an investor, where do you want to put your money? Do you want to put it in a unit trust where you can easily access it? Or do you want to buy a treasury bill to make an extra 80,000 profit? Now, if you are buying a treasury bill of 1 year and above, 1 year, the 364, and the interest rates are above 15%, it makes economic sense to buy a treasury bill instead of a unit trust. But when interest rates are falling, like what we are seeing right now, if the interest rates are to drop, let's say to 14%, you are better off buying a unit trust than buying a treasury bill for 1 year. For example, if we are to take this same concept and bring it here, right? If someone is to invest for just 182 days, they have to pay 9.3 million only to get a profit of 500K after tax. Remember, the tax on the treasury bill is 20%. It's what makes it hard. Yet for the unit trust, it's not taxed. So if that same person, another person got this 9.3 and they came and invested in a unit trust that gives around 11%, in 6 months, which will take us up to June, this person will have 8.7 and they would have made around the same exact amount of money as a treasury bill of 6 months. The only difference that someone who has invested in a unit trust, they can access their money whenever they want as compared to a treasury bill. And we're going to talk about the liquidity of that. So when it comes to the treasury bill, if I'm to come back to this, is know that the treasury bills, they have the lowest interest rates when it comes to treasury bills and treasury bonds. The tax on them is 20% and they are sold at a discount. So before you buy a treasury bill, compare the return you are going to make, the return after tax, to what the return you are going to make if you were to put that exact amount of money in a unit trust. The only time as a retail investor you should invest in a treasury bill is if you are investing for a short period of time. You are investing for just 90 days, 182 days, or 364 days. And that is the same exact time you can invest in a unit trust. So the question for you becomes, does it make sense to invest in a treasury bill or does it make sense to invest in a unit trust? If you are investing 100 million plus and you have plans in one single year to do something, yes, it might make more money for you to buy a treasury bill. But first look at that return, factor in the tax component, and see the final figure. That brings me to the conversation of treasury bills. The important things I want people to take in is buying a 91-day treasury bill. You pay a lot of money and you make very little profit. You can see you are going for a 91-day treasury bill, this one here, You are paying 9.7 million to just make 200,000 in 3 months. It can be a good investment, but you can make that money in a unit trust. So it might be better to put your money in a unit trust. But if interest rates go high above 15% for treasury bonds, treasury bills, then it might make more sense to buy a treasury bill. Also, the alternative to a treasury bill is a fixed deposit. If you have 100 million, you are in diaspora, you're about to leave Uganda, you know next year you're about to do a construction. You can walk to any bank and say, okay, I have 50 million. I know I will need this money in 1 year from now. Do I buy a treasury bill or do I put it in a fixed deposit? If I put it in a fixed deposit, what rate are they going to give me? The more money you have, the more these days banks can negotiate rates. So when it comes to treasury bills, that tax element, it makes them a little bit unattractive, that you would want to first think about them before you take an investment. I want to see if anyone has a question on treasury bills before I move on to the treasury bonds. But I know most of the concepts are going to come in later as we talk about the treasury bonds for you to understand on that. Okay, thank you. Anyone who is raising their hand, if you have a question, kindly post it in the chat. Thank you so much to avoid disruption. Fixed deposits are with the different banks. Now, I do not want to create an endorsement of any bank, but whatever bank that you belong to, and we're going to talk about them later, you can go in and say, I have 50 million, I want to invest it for 6 months. What rate do you give me on a fixed deposit? One thing you should know about fixed deposit is they lock you in. If you are to break a fixed deposit contract, you might pay a penalty. So you must understand that. 2, the income that you make on a treasury bill is taxed at 15% withholding tax. So that is something that you should be aware of. Then someone who was asked to talk about unit trusts, I was to talk about them later, but let me bring them now. In Uganda, unit trusts, we call them collective investment funds. Collective investment funds is an investment option you have right now, that it should be literally like your bank account. Any money that you should be having that is not doing anything, even if it's just for 2 weeks, put it on a unit trust and it will make money. The good thing with all unit trusts, your money makes money every single day. Every single day. And these are the 8 unit trusts we have in Uganda. We have Old Mutual Investment, we have ICEA, we have Sanlam, and this is part of the exhibit that I sent through. It's on page 19. They are fully regulated by Capital Markets Authority. There are controls in place that your money is safe. You are not investing with a Kakande, you are investing with fully licensed and approved companies by Capital Markets Authority. This is a Capital Markets Authority report. And if by now you have not yet invested in any money market fund or unit trust, you are missing out. But when it comes to unit trusts, the most important element you should know is this. And thank you for this person who has asked that question for me to take back a step back on unit trust, and I cover them at once. It's the best investment you can do for your emergencies. We all know at one point BOC we shall always have an emergency. It makes no sense for you as a person right now not to have an emergency fund. Your emergency fund can't be your savings account. And what do I mean by an emergency fund? You having the capacity at any one point when you have an emergency, you can access your money in 24 hours and take care of the business. That's what makes unit trusts relevant in this assessment. But remember, they make money as you make money. It's not like you're just depositing your money there and sitting, even if you're having it on mobile money, you know? Which brings me back to the unit trust tracker. They, on average, all of them give around 11%. And this is not an endorsement of any, but it's an endorsement of the industry because they serve an important purpose. Whichever you choose from. Let's assume at worst, you're going to get a 10% return per year. When you change this number, for those of you who have managed to open a unit trust tracker, you just need to change this figure. This will automatically update itself and the numbers will update. And I'm assuming at this point I have a client, Joan, and we have sat down and said, okay, we must invest, we must start building our emergency fund. And all you can afford is 100,000 every single month. Then you just come and put here 100,000 every single month, dedicatively. Every time that they pay you, you get any income from your business or from your salary, you deposit on a unit trust. It will grow. If you start in March, even if let's take it there and start here, where we are, what will it be like? I'm looking at this. I'm going to be referencing to it a little bit more. Why? Majority of us on this call are within 25 to 34. We have a few young people. Now I'm talking about someone who is 11 years, 15 years, and somehow all they can afford from whatever mommy or dad is giving them is 20,000. You can still do it. But for them, they have a lot of time on their hand because if you are 15 years, the power of your compounding with a unit trust is way much bigger. And nothing is going to teach you about finance like a unit trust. So all of a sudden you say, I can afford 20,000. You just keep on depositing that every single month. You keep on, all of a sudden your money is growing. At one point, let me come back here. In 7 years from now, right? By just depositing 20,000, you'll be making more money than the amount you are making, you are depositing. And that is true for the young person who has just graduated, who is just making just 500,000 and all they can afford is 20,000. But maybe another friend of mine, Mimi, she can afford 100,000. For you who can afford 100,000, your target is what? 12 million. At the same period, you will be making more money than what you are depositing. Then you maybe for you as a person, you say, I must hit your emergency levels is maybe 20 million. It means you must deposit a little bit more money. Then maybe you are depositing 300,000. That's 3 million. It will grow. In 8 years, you'll have reached 40 million, close to 40 million by depositing just 300,000, whichever unit trust you go to. You know? So unit trusts, and they should be part of your investment portfolio in such a way that that is where you put money you know you might need at any point in time. It should be part of your investment component. And it goes back to these 7 of them, whichever, let me make it even bigger. Anyone you want to choose from, they almost averagely give the same amount. The question becomes, which one do you want to choose from? Which services do they have? What return do they give? And everything. But any of them is in that. Your emergency fund should be that. Also, maybe it might not be an emergency fund. It might be funds that you know you might need. You are not sure where you might need it, but you might need it at one point. Put it in a unit trust. It's called a money market fund. Where do money market funds invest? They invest in treasury bonds. Now, let me first put unit trusts at this point. I'm going to come back to them later because we're going to do a little bit of comparative to them. I know a few people here are invested in unit trusts and they want to see what the treasury bonds are. Coming back to the treasury bonds, I believe everyone now understands treasury bills or has an idea of treasury bills. Now we are coming to treasury bonds. Why treasury bonds? Whatever the decision you have as an individual, it might be that you want to grow your money. It might be that you want to have financial independence. It might be that right now you don't know what the certainty of certain things are. Treasury bonds should be part of your investment. There are two types of treasury bonds, how I split them up. There are these ones which are what we call the medium term treasury bonds, 2 years, 3 years, and 5 years. And then there are those which are long term, 10 years, 15 years, and 20 years. The medium term, it means it will mature in 2 years' time. You buy a treasury bond right now, in 2 years, they will give you back your money. The 3 years, it will give you back your money in 2028. 5 years, 2029. So you make a decision based on your goals. You are 55 or 45, you know in 5 years you might need money to do something. Then you buy a 5-year bond. You are 2 years, you are 30, you know in 2 years you might want to go back to study and you need money to go to study. You buy a 2-year bond. You are 45, you know your goals are in 5 years, you might need money to do something. You buy a 5-year bond. But remember, they have a 20% tax. We're going to come back to that. Long-term bonds, they are 10-year bonds, and 15 and 20 years, they are long-term. Their withholding tax is 10%. So when you are buying a treasury bill and a treasury bond, the tax element is extremely important because it guides on how much you end up making as on your investment. For the majority of us who are young, who have 20 years to go before we retire, our plans are full-time plans. People who answered this and they said their goal is to achieve financial independence. Achieving financial independence is a long-term goal. You should be buying bonds that are long-term, where they make a little bit more money and you pay less tax on your income. I'm pausing there for a second. You should be making long-term bonds that make more money for you, which then becomes, what bond do you then want to buy and what makes a bond attractive to you? I'm going to present another Excel. Apologies, we're going to go through quite a few Excel because I want this to be as practical as possible for you to understand what makes a bond worth for you. Let's start with, let's say, a 5-year bond, right? A 5-year bond, I'll come back to this to explain something here. These are the 3 important things you should know about bonds. Those 3. And we're going to discuss them. The first one is, when is the bond maturing? Does the maturity period align with your goals? If your goal is to have a bond for 5 years, does it make sense for you to buy a bond of 5 years, or does it make sense to buy a bond of 15 years and sell it after 5 years? The cut-off price. The cut-off price is the price you pay. Now, what I'm presenting is the primary form. But even in the secondary form, the cut-off price, they will tell you what is the price that you are going to pay. The cut-off price is always determined by something we call the yield. And for those of you who read my articles, I know you pay attention to the word, the yield. I talk about it a lot, or the interest rates. The strategy when you are buying treasury bonds is you want to make sure you are paying cheap. You are paying when interest rates are high or yields are high, which means you are going to get a discounted bond. And you want to sell, if you are to sell, when interest rates are going down, when you're going to make a profit of your bond, but we're going to talk about it later. So when it comes to a treasury bill and the treasury bond, this yield is very, very important. Even if you're buying on the secondary market or wherever you're buying. So the yield is to say this here is what determines the price you pay. And how does it determine it? That brings me to this Excel, right? So we have a 5-year bond here. It has a coupon rate. What is a coupon rate? I'll come back to this. When treasury bonds are issued, they are issued by the government. The first time they are issued, they set what we call a coupon rate. It never changes for the life of the bond. It's what determines the cash flows that you will be getting every 6 months. The coupon rate, even when you come to hear this calendar, you will see, right? I'll make it a little bit bigger. You will see that it's there, 14.7, 14.125. It's there, 14.1, 14.25. It's there. It never changes. The coupon rate never changes, even if the bond was issued 10 years ago. So when you're buying a bond, you have to say, okay, what is the coupon rate? That's what is going to determine what you're going to be getting paid every 6 months. So that is the element here. Very, very important. Then the yield to maturity. This is what we are calling the yield. This is what determines what you pay. And this is the secret to treasury bonds. You always want, when you're buying a treasury bond, you always want to make sure that number is high. And let me use the concept of land, which people can understand. Imagine you are buying land. You know your land is 10 million and you end up paying it for 9.5 million. It means you have got a discount of 500K. There is an element of the yield. Even on treasury bonds, that element is very, very important. That one there. If you go to the bank or you're buying a bond, the first question you have to ask the people, what is the yield? What is the yield that I'm paying for this bond? You know, when that yield is high, it means you're going to buy the bond at a discount. So for example, here I'm putting 15.55. The actual amount you end up paying is where? Let me first put this out. The actual cost you pay is this. If this number goes up by 16, you see the figure goes down. If it goes to 16.5, you pay less money. But imagine it is to come to 14.5%, then you have to pay more money. If it comes to 14, oh, sorry. If it comes to 14%, then you end up paying more money than the bond you are buying. And very few people know this. So when you're going to the bank, to buy the bond, you have to ask, what is the yield I'm paying? Do not ask what is the price. You ask what is the yield, and make sure that yield is as high and higher than what the coupon rate is, because the coupon rate doesn't change, but this can change. And the higher it goes, if I'm to make it bigger for people, if it ever reaches 16.5%, You're paying a discount. You're paying 6.4 million and you're getting a bond of 5 million. And that's the first question I think Primo was asking. I'm seeing these gains and losses. What is causing them? The first gain you make on your bond is this. How much have you paid? This. How much have you paid is this. What value of the bond have you got is this. So that means the first gain you're going to get is that. Right away. Then this coupon rate determines what you're getting paid. And the coupon is based off the value of the bond. That's why we can do that times the coupon rate and we get the 715, which is a total of that plus that. Remember, bonds pay a coupon twice a year. So the first important thing when you look, every time you look at interest treasury bonds, is to ask yourself, what is the interest, what is the coupon? They always state them up. And what are the interest rates? The interest rates are these what they call the yield. When you go to the bank or talking to someone, you're trying to buy a bond or selling a bond, you ask, what is the yield you are paying? Whatever bond that is out there, it has its own coupon. That never changes. Right? So when you understand that the yield is what determines what you are buying, then you have to come back at this and say, which bond should I pay for? It goes back to saying, let's assume you have 10 million, someone who has just 10 million. If they come here, this is the 20-year bond on this calendar. This one, this code. For so many of you, it's the bond that is getting auctioned next week, but we're going to talk about it later. That bond is one of the most sought after bond right now. Why? Because it's at a discount right now. The question becomes, does it make sense for you to buy it? If all you have is 10 million, then you have to come and be like, okay, and we're going to do this live. We're going to do an assessment live for this. This is my trading platform. It's live, so you I hope I don't lose you. So this is the 20-year bond, the Ugandan bond. So this is how interest rates have been moving. It started off when it was issued at 16.4. It goes up, it went down, it goes up. It reached almost 18 a few weeks ago. Now it's going down. So the question when you go to buy that bond, you have to ask yourself, is it worth for me? Let's assume you want to buy for 10 million. And they tell you that the yield, which we said it's the most important number, is 16%. It means someone wants you to pay 9.6 million and you're going to be getting a coupon based off 10 million. Now, I've already worked it out here. If you buy that bond on Friday, Saturday, this week, it means you're going to be getting a coupon every 6 months of 675. And since the bond pays a coupon twice a year, it means times 2. Why am I using after tax of 10%? It's a 20-year bond. 10 years, 15 years, and 20-year bonds, they pay a coupon and the tax is 10%. So then your question is 9.6 million. It's what you invested. Every year you're going to be making 1.3 million. That means the profit you are making is the 1.3 million versus the amount you have invested. The after-tax profit, it's 14%. Then you ask yourself, Am I better off buying that bond? What about another bond? We have on here the 15-year bond. The 15-year bond right now is trading at around 15.8%. At 15.8%, let's assume both of you are trying to buy a bond of 10 million. Right? So this is something which I want us to pay attention because it's very, very important. Two bonds, the 20-year bond, it has a coupon of 15% and its yield is 16%. And someone is going to pay just 9.6 million. The 15-year bond, it has a coupon of 15.8%. It means the 15-year bond has a higher coupon than the 20-year bond. However, the 15-year bond has a lower yield or a lower interest rate. Right now, it's going for around 15.8%. And if you are to get it at 15.8%, you're going to pay a little bit more money. So that means from word go, you are paying a premium of 249K. So if both of you want a 10-year bond, I have Grace. He chooses to go for the 20-year bond. He gets his first discount is 355 because he's going to pay less money. And then you have Alex goes for 20-year bond and he pays a little bit more money. So that means one of the person is starting at a different footing. You know? Guys, can you wait to put in the questions and I first present, then you put them in where I can track them? That would be very good. I might end up missing them. Right? So when you you buy this for the 15 years, which has a higher interest rate right now, you end up paying a premium than someone who bought for the 20-year bond. And then you end up making every single year 13.87 return. This one makes 13.99. So then the question becomes, which bond do you choose for you? Two things that are very important on that. If you want to make more money, you always want to choose a bond that has a higher interest rate. It means you're going to buy it cheaply. Two, you want to choose a bond that has the tax that is low, which makes the long-term bonds much better than the person who buys the 5-year bond or the 3-year bond. As you can see, before compounding, which we're going to talk about, you already are making close to 13.99 return, and this person is making 13.87 before compounding, and that's after tax. After tax, because these are the numbers I'm using that are after tax. Right? So it's not necessarily that the bond that has a higher coupon will make you more money. No. Not at all. And to demonstrate that, let's do it live. Let's go to the Bank of Uganda website and we see the transactions people have made recently. When you come to Bank of Uganda and you come to financial markets, you can always come to this daily secondary trades. It shows you how the market is performing. It's a day late, but it gives you an indication. So when you click, for example, this is yesterday's transactions. Let's calm down. So we're going to analyze a few details here. Let's start with this one. This person bought a bond yesterday, the 20-year bond of 100 million, and they paid 94 million. And this is how it works if we come back to this. 20-year, they wanted 100 million. And it was their interest, the interest rate. This column is the yield or the interest rate. They paid 16.3. So this is the amount they paid, which you can confirm it's the amount here, right? That person means the amount they made, the profits they made every single year is 14.25, which is around 14.26 every single year by buying a 20-year bond at 16.3. What about someone else? Then someone else bought a bond of 250 million, the 5-year bond. Let's go there. 5-year bond is here. What interest rate did they get? 16.1. What was the bond they bought? 250 yesterday. You can see they paid 360 million. It means they got a discount right away of 13 million. And what is their actual profit every single year? You just times them 2 divide by that. So for them, they are making a 13.58 profit. So it means this person who bought a 5-year bond is making a lower return compared to someone who made a 20-year bond who made 14.26%. But the question is, let's assume if they were buying the same amount of bond of 250. You can see they would have paid almost the same amount, but this person would make a little bit more money. The most important question is, who made the right bond decision? Because that's the question you have to ask yourself. Let's come back to that website. And that goes back to you as an individual. Are your terms, if this person's plans are just 5-year plans, then he got the right bond. He got it at a discount and he got it at a very good interest rate. What about this person? If this person, their long-term investment plan at 10, 15 years and above, then automatically he made also a good decision because he's making more money than what the other person is making. But what if this person wanted to invest for 20 years but ended up buying a lower bond, a bond of 5 years? That means they left some money on the table. So it goes back to the question I started with. Depending on what you are trying to invest in, how long you're trying to invest for, you want to align the bond you buy with the kind of money you end up investing in. Right? So if you want to invest for long-term bond, you go for bonds which are 15 years, 10 years, 15 years, and 20 years. If you are going for a bond of, you want to invest for 5 years, 10 years, then you buy a bond of 5 and 10 years. But you must make sure that interest rate there is as high as you can negotiate it. Which brings me to the question, when do you know when then to invest? That brings me to an exhibit. Okay. Where is it? Where is it? Give me a second. Okay, I can't see it, but I remember I shared it. Let me open it on this side. So in January this year, interest rates reached as high as 17%. 17.5%. And why they reached that level? Okay, here we are. Because at that time, the government needed a lot of money. So if we are to go to Jan this year, you can see interest rates reached 17.8% in the primary market. It means someone who wanted to buy a bond of 100 million ended up paying just 86 million. And they are making a profit of 15.5% per year. Now that brings me to the most important question of why I'm actually advocating for people to invest in treasury bonds. There are not so many businesses you can do in Kampala or in Uganda or for our friends in Kenya who are on this call or even our international friends that can guarantee you a return every single year of 15.5%. Yet the person who bought a bond in Jan, they have locked in this return for the next 15 to 20 years. It does not change. They're always going to be making that investment before compounding. But this was in the primary market, which brings me to the second important conversation. I'll come back to my presentation. We have talked about bills and bonds. Now I want to talk about the market. It's very, very important to understand, especially for those of us who are in Uganda. There is the primary market, there is the secondary market. The primary market is when you are buying a treasury bond or treasury bill from directly, keyword, directly from Bank of Uganda. And when it comes to treasury bonds, they are sold once every single month. And it's on a specified date. So if at any one point you want to buy from the primary market, you must know, you must have the calendar, this calendar, and say when is the next auction. That the next auction is on 19th March 2025. Which bond are they selling? They are selling the 2-year bond, the 5-year bond, and the 20-year bond. You must know it. Then you ask yourself, is that a bond I want to buy? Then you say, oh, I'm trying to buy a 10-year bond, so it's coming. Then you buy it at that point. You know, this is a 10-year bond there. That is the primary market. You can only buy on a specified day. Right now, it's coming in 2 weeks' time. Then we have the secondary market. The secondary market is wide and it is the best market. It serves for everything that you can't get in the primary market. One, you can buy at any point you want, whether it's now, whether it's tomorrow, whichever bond you want, you can buy it from the secondary market. And what is the secondary market? The secondary market is mostly dominated by the commercial banks. So you go to your bank and say, I want to buy this bond. What is the price? In the secondary market, you can negotiate. The more money you have, the more interest rate they will give you. In the primary market, for us retail investors, we cannot negotiate. They'll give us what a cutoff price is, and which we talked about, the final price. So in the secondary market, it's where you can sell your bond. So understand the two components, the primary market and the secondary market, and they are uniquely different. Even when you are right now, because we are still in the paper-based kind of investments, even the form you fill up is different. Where is it? Bank of Uganda. Here. When do you know you are buying from a primary market? Is when you go to a bank and the form they give you looks like this. Now, I encourage people with less amount of money, 5 million, 10 million, try to buy from the primary market. If you cannot know how to negotiate, try to buy from the primary market. Target when to buy and go buy it from there. Why? You get a good price. And the form you must fill up should look like this. If they give you a form that doesn't look like this, you have to question, am I buying from the primary market or the secondary market? Then the secondary market form looks like this. They are totally different. You can see this is tabular. This one is in a different way and it has the word called auction. So when you go to the bank and your target is to buy from the primary market, ask for form 2. But I sent this form in the exhibit. You should have it. Exhibit W. So when you go to the bank, you should even know what form you must look at. But when you have more money or you want to buy a bond that is not on the primary market, then you go to the secondary market and the form will look like that. Which brings me to the question, when do you want to buy from the primary market? When do you want to buy from the secondary market? The primary market is when if you have less amount of money at any one point in a time, you buy from the primary market, from the secondary market. When you have 50 million, you're going to go to any bank whatsoever you bank with. Post Bank, DFCU, Housing Finance, Stanbic, all of them, the primary bankers, they will sell you the bond and you will fill up a form like this. When you have less amount of money every single month, 1 million, 2 million, always buy from the secondary, from the primary market. And even if you are in the diaspora, yes, you can buy from the primary market. You just have to reach out to your bank, and when you get this form, you fill it up and scan and send it to your bank. Many banks are starting to embrace receiving instructions from on email. But you have to coordinate with your relationship manager to say, here is my form, please take it to the Treasury back office for them to fill it up. Now, should you buy from the secondary market? Of course, yes. Right now, you have 200 million. You want to buy a 5-year bond. If you have to buy it from a primary market, you have to wait for 60 days. You don't know how it's going to be. Go buy it from the primary market right away. If you want to buy a treasury bond of 15 years right now, you have to wait for 40 plus days. Buy it on the secondary market. But if you want to buy a 10-year bond or 20-year bond, it's coming in 1.5 weeks. Why not buy it from the primary market? 2, if you have all you have is 100,000, 200,000, buy right away from the secondary market. Why? The primary market, depending on the bank you have, and I do not want to endorse or anything for the banks, you have to ask, if you are to buy from a primary market, what charges do they charge you? Some banks charge as high as 20,000 for every auction form they do for you in the primary market. Quote me well. So if you're buying, like one of my bank, they charge us 23,000 every single month. We have to buy from a primary market. So if you have 100,000, it means you're going to end up spending the 100 plus the 23,000 to buy a bond of 100. It makes no sense. Yet if you are buying from a secondary market, they won't charge you no matter what. So if you have 100,000, 200,000, you're just starting in this market, buy from the secondary market. It makes the cost down. Someone is asking, the primary market, the secondary market, is this the second bond market? Okay. The secondary market is the active trading it's where you can buy a bond. Let me break it down the simplest way possible. Right now, I buy a bond from Bank of Uganda, but then I've bought it to sell it. I have people I want to sell it to. I can only sell it to them in the secondary market. I bought it and I sold it. Banks do this, it's part of their business. And even you can do it if you know what you have to look out for. If you buy a bond in your names, 3 years later, you want to give it out to your child, you do a transfer. See this here? A transfer is when you transfer a bond to someone else for free. They don't need to pay you money. That can only happen in the secondary market. When you want to sell a bond that you have bought to the bank and get some of your money, you do it in the secondary market. So that is the secondary market, all of it. And I'm coming for the people who want to understand how do I sell the bond? We're coming to that. So which brings me to understanding these components we talked about. Taja, I'm coming to that. On some, I'm missing a few questions, but I'm going to address them as we go through. Remember, I talked about that the coupon rate is standard; it never changes whatsoever. If they issue a bond for the first time and its coupon rate is 15, it will forever be 15. Now, when you go to buy a bond and its interest rate is equal to the coupon rate, you will always pay the exact amount worth of the bond. To demonstrate it for you here, someone said the figures are not good. I'll expand on this. When the interest rate is equal to the coupon rate, you can see these are equal. It means someone who is buying a bond of 100 will pay 100 right away. Right away. That's the first component. The second component is when the coupon rate is less than the discount rate. That means the yield is higher. You get a discount. For example, the coupon rate is 15, you buy it at 16. See, you make a discount right away. And this is where you make money. You want to always buy bonds that are at a discount. You want to buy bonds when the interest rate is high. Thank you so much, someone who has raised it. 1 million. If you have 1 million, you want to buy a bond of 1 million, you're going to pay 940,000. Let's assume you have a 5 million. You're going to pay 4.7. Let's assume you have just 500K. You make a discount of 29K. When interest rates reach 617, you're making it a bigger discount. So you want to always buy a bond when the discount rate or the interest rate is higher than the coupon. But sometimes the interest rate can be lower than the coupon rate. Then you end up buying a bond at a premium. It happens. Not often, but it happens. So for example, if let's say it's at 14.5, so you end up paying more money than the bond you are buying. So when you go to buy a bond, you want to buy a bond, you have to ask what is the yield. And someone who asked who determines the interest rate. If you are buying from Bank of Uganda, it's Bank of Uganda. If you are buying from the secondary market, it's someone who is selling it to you. You know? And someone said, can I buy a bond if I'm below 18 years? Yes, for as long as, now let me talk about that actually. And for people who are in the diaspora. Buying a treasury bonds, all you need right now in Uganda is a bank account. For as long as you have a bank account with any commercial bank, you can buy treasury bonds. Now, even if you have a child right now who is 5 years and you have opened them a child bank account that you manage, it means you can still buy a treasury bond in their names. So for as long as you have a bank account, if you are in America, you are in the UK, you have a bank account in Uganda, you can still buy a treasury bond. If you're not in Uganda and you need to do something, you just have to reach out to your bank and open up a bank account, and you'll be in position to buy a bond. So having explained to you, this is a very important component. This is what determines what bond is good for you. Is the interest rate equal to the coupon? You are paying exact amount of money. If it's 15, that means you're going to pay 5, you're going to pay exactly that. If you are just having 200k, I will use the lower amount. It means you're going to get exactly 200k. If you have just 1 million, you pay 1 million. So when interest rates goes up, then you pay more or less money. So the secret to making money, the first secret to making money is to make sure you're buying bonds when the interest rates are high or are higher than the coupon of the bond you are buying. Now, strategy. And I know this is where most people are having questions. How do I know? Can I buy and sell my bond before maturity, or can I trade in treasury bonds? Remember we said, I will take back to this question. When interest rates are high, it means you're going to pay cheaply. When interest rates are low, that means you pay more money. So it's the same. For anyone who wants to buy and sell bonds, you want to buy when interest rates are rising, because it means you're going to buy them cheaply. Yes, they have what we call an inverse relationship. When interest rates are rising, that's when you want to buy treasury bonds and treasury bills. When interest rates are going down, that's when you want to sell your treasury bonds, because that means the bond you bought cheaply, now its price is going up. So to demonstrate that is to say, let's assume you have 10 million. You buy the bond at 17 right now, and you pay 8.8. I'll put this figure somewhere here. Then 3 months down the road, they tell you that bond, the interest rates have reached 16, right? 16. So it means 17% rate, 16% rate. So it means if you are to sell at this point, you make a profit of 530 by just targeting interest rates up, down, up, down. When interest rates are going up, buy. When interest rates are going down, for those of you who want to trade, that's when you have to sell. But should you trade? Should you trade? I do not highly recommend it for retail investors. The question is one of the biggest questions I've seen coming through is it easy to sell my bond? I will say it this way. When it comes to treasury bonds, I will demonstrate it, because if I say it, you might get lost on it. I'm going to take a step back. I said you can buy your bond from any bank you can think of. But in banks, we have what we call primary dealers and secondary dealers. In primary dealers, these are the only primary dealers we have in Uganda. Now the question is your bank one of them? We have DFCU, ABSA, Centenary, Housing Finance, Stanchart, Stanbic, City, and Equity. Part of their mandate on being a primary dealer is for as long as someone wants to sell their bond, they are mandated to buy it on that exact day. Let me repeat this. The primary dealers, one of these banks, is mandated to buy your bond no matter what. So do never worry that I might fail to sell my bond. No. You will sell it, they will give you the price. You will sell it, they are mandated. If you go to them and say, oh guys, I want to get my money today, they will give you your money and they will buy the bond. It's part of their primary dealing. You know? So that means do not worry about selling your bond. What you should worry about, you as an investor, is to say, hey, what price are you paying me? It's the price that matters. Make sure it goes back to, if you can take anything away from today, and there are things which I'm going to emphasize, the first thing you should take away is this interest rate. You want to make sure when you are buying, the interest rate is up. When you are trying to sell a bond, you must make sure you are selling it when the interest rates are down. 2, when you go to buy a bond from the bank, for those of you who read my email, my mailing, and I know this, I know we're about to talk about the different risks, but I wanted to first emphasize this. For those of you who read my emails, for those of you who don't read it, here is the link you can click to go to the website. Right? This is an email that came out yesterday, where I'm talking about the bonds that are getting sold in 2 weeks' time. This is the Bank of Uganda that is about to sell these bonds. But remember, the bonds that are being sold, me, Kakande, let me not talk about any bank. Most of my banks are very good friends of mine. Me, Kakande, I have it. I bought it before. That bonds have been on the market for the last 2 to 3 years. So if Kakande is a bank, when you come to me and you don't know what you want to buy, I might end up selling it to you. So someone asked the question, how come the bank is selling in 2 weeks' time, but people bought today and yesterday? That is the secondary market. So you have to go to the bank knowing, you have to go to the bank with facts and say, okay, I want to buy this bond. Bank Kakande has it. Do I want to buy from Bank Kakande or do I want to buy from Bank of Uganda? If I'm buying from Bank of Uganda, then the form I must fill up. Where is it? If I'm buying from Bank of Uganda, this is the form I must fill up. If I'm buying from Bank Kakande or the different commercial banks, then the form I will fill up will look like, where is it? Come on. Like this. So by understanding how the market works, what is the primary market, what is the secondary market, it guides you on where to make the money. But bonds do not make money by you buying once, which brings us to the most important element of investments and of finance, the power of compounding. In finance, we always talk about What I've talked about is the gymnastics of the market. Now I'm coming to you. This is the most important part. And I'm going to use examples here. In the attendance pack, I added something called Treasury bond exhibit tracking. So you are 35. I have a client of mine who we have set a very ambitious target. I'll come back to those. I have a client of mine who have set a very ambitious target to say in 2035, 2030, she must reach a 2 billion bond portfolio. Extremely powerful ambition. Now that is her. You as a person, your ambition might be different. Erasmus, I'm going to come back to that. Your ambition might be different. Your ambition might be in 2030, you must have a 50 million bond portfolio. Or you might be earning around 2 million. When it comes to treasury bond, there are three things that are very important. You have to maximize your investment contribution. Do not come to the bond market with, let me try it out. Put there the best effort forward. This is your money. The same way you say, I earn $1 million, but I can painfully save 300,000, right? Invest that 300,000 every single month. 2, determine which bond to buy. If your goal is to maximize profits, always buy long-term bonds. Apologies. Why? The long-term bonds are going to give you a lower profit, a higher profit and lower tax. And then learn to compound your bonds. And what does compounding mean? It means every single time a bond gives you a coupon, you buy another bond. So let's come back a little bit here. I have a friend of mine, Peter, who is just getting interested in treasury bonds, right? And they bought their first bond in Jan, 10 million. And the goal is to say, we created this tracker for them that the bond you have bought is going to be giving you interest rate every 6 months. Every 6 months. Now, to compound it means every time they give you the 600, buy another bond. You just have to keep buying. It doesn't matter. We're going to talk about the strategy of buying, but just keep buying. That is what it means to compound. That's where, as a person, you start with 10 million here. And for those of you who have this Excel, you can do with your numbers and set up your goal, right? So let's assume you buy a 10 million bond and say I'm buying it at, let's say, a net income. Net income is after tax of 13%, right? And 13% means the gross rate might be is like 14%. Now, those are the cheapest bonds there. Like when you're buying a bond of a gross rate of 14%, in Uganda, you're buying a very expensive bond. But even if we say someone buys at 16% or 15% coupon, let me use 15%, that means the net return is times 90%. Tax is 10%. So that means every single year you're going to be making 1.35 million the first year. That 1.35. And when you make that 1.35, then you come and use this money to buy another bond. So this is the component I'm talking about here. You just have to buy any bond and compound your investments. It's not automatic. You must, every time they give you that money, it comes to your bank account. You have a bank in Bank of Africa, Post Bank, DFCU, Stanbic, Housing, it will come to your bank account. Then when it comes, it's upon you to know when is the next bond auction or can I buy from a primary market. Then you end up buying another bond. Then someone who starts with 10 million and they do not add in any more capital whatsoever, and they start in 2025, by 2040 they will have around 86 million. Now you'll be like, how? Yes, the bonds, because they are reinvesting their money, the money will grow. But what if they start with 10 million and every single month they contribute just an extra 200,000 to buy another bond? And they do it for the life of their bonds. So that means right now you are 20, you are 25, you are 35. You can afford just 10 million and an incremental of 2.4 million per year. You're going to wake up in 2040 when you have 200 million. Your goal might be different whatsoever, my friends. You have this Excel. It's one of the best. Now you might be having less money and say, oh, all I have is 1 million and I can afford just 100K per month. It's okay. But you're going to wake up when you have around 76 million. It's more than what you started with. Don't feel bad. You started with little. Then you are having a little bit of more disposable income. You have 50 million and you can afford a 500K here per month. You're going to wake up to 700 million. These very few things, and I'm being very realistic here, very few things you are going to invest, especially if you are if you are employed. Majority of us, we have a few lawyers, we have a few people who are highly career oriented. That you are going to do that is going to give you this return. Very, very, very few. And to be very categorically here, even if it's land, if you start with 50 million and you don't do anything but you compound your money, you're going to wake up with when the value has gone to 400. What about if you keep on adding just an extra 500K? And this figure can be anything. It can be just 100K. That's what you can afford. Someone can afford 1 million. Your goal is to say by the time I retire, I should have 1 billion in profit in bonds, and they would be giving you almost 130 million times 12. That's 10 million every single month. You are doing nothing. You have continued chasing your career. You have continued chasing your businesses. This is just passive income. If you are earning 1 million right now and you want to in 5 years to be in a position to have a passive income of a half of what you earn, treasury bonds is the real deal right now. If someone right now sits there like, Alex, you're using big figures, start with just 5 million. $5 million. And also, I have 1 million, 100 per month. They will grow it. By 2030, in 5 years from now, they will have over 20 million. And you think maybe 2030 is far away. Let's take a step back. Let's assume this was let's assume someone started in 2020. Where we are right now, they would have reached 20 million. And all they started is with 5 million and they're putting just 100K away. That's all. Now you go and tell me which land you bought in 2020 at 5 million and spending just 100K per month and it is worth 20 million. I'm waiting. And actually, in 2020, interest rates were over 17%. Now, I will continue using the 13.5%, the lowest it will be. Even if we are to go back in 2010, 2011, if someone had the benefit of knowledge, that's in 2010, interest rates were over 19%. And where would they be by 2025? Over 160 million. You bring me a plot of land you could buy at 5 million that would be over 160 million, and you just left it there sleeping. That is the power of the treasury bonds. But let's continue at 15%. Your goal is to say, I will keep buying. Now, people will be like, how do I know which one to buy? I would even say it won't matter. If you consistently buy bonds, you're going to wake up when you buy the first bond, they will give you a statement like this. It will have your name here, it will have your number and the bond you have. But if you do it consistently every single month, just keep throwing money into buying, you're going to wake up one day when your statement has more bonds. This is someone whose bank statement, but portfolio. It will have, whether you're buying bills or bonds, it will have the figures. It will have different bonds that mature differently, that pay you at a different point in time. Just keep buying. It will automatically compound. I know a few people always want to say, should I buy the same exact bond? It doesn't matter. What matters is this. How long do you want to invest for? That I want to invest for 20 years. Then just keep buying bonds that are above 15 years. How long do I want to invest for? 5 years. Then buy a bond that is 5 years and above. How much tax do I want to pay? 10%. Then buy bonds that only have a tax of 10%. You are buying for your child, or I know there are people who brought in their children here. Amazing gift you are giving them. A child who is 11 years, Tosha, you have no business buying a bond of 5 years. Your business is to buy bonds of 20 years only. Because at 11 years, in 20 years from now, you'll be 30. When you ask the 30-year-old right now to think about 20 years ago, they'll be like, the only thing I could know was what? Primary? How to play? An 18-year-old right now, you have no business buying a bond of 2 years. Buy 10 years and above. Even a 35-year-old, your goal is financial independence in 15 years from now. Look at when you are creating your investment plan, your goal is to say, in 15 years, I will be 50. Let me look around how 50-year-olds around me or who have taken a similar career path are like. Then you're like, what can I do differently? Then you go to buy a bond, you buy those that are long term. It's okay. One day you're going to wake up when your custody statement has as 10 or 20 or bonds and they'll be paying you. To other people, they're going to be like, my strategy is to be paid. I have 100 million. I want to be paid money every single month. One of my clients is almost obsessed with it. Like, I need to come up with a strategy where every single month I'm getting some money. And we say, oh, it's okay. Then we come and say, okay, what are the different bonds that okay? We have this bond here. As you can see it pays in June and Jan. It pays in Jan and July. Then you look for another bond that pays in Feb and August, the 5-year bond. Then we look for the 10-year bond, this one, that pays in March and September. Then we look for the 15-year bond that pays in May and November. You know? But one of the mistakes people do, and what the mistake she was about to do, in her obsession, in trying to make sure she has all the bonds that pay in different months, she wanted to buy them all of them at once. Sometimes not. Sometimes you have to allow to build the bonds over time. The component which people talk about if you have heard about bonds, which we call the bond laddering. Very good concept like the compounding bonds, right? Bond laddering is to say at one point I need to have bonds that pay me differently, that mature differently, that all of a sudden that can allow me to get cash flows every now and then. That is not something you can build in 1 month. And if you end up doing that, you're going to pay a high price because you're going to go to the bank and say, I want a bond that pays in April and October. That bond, the only people who have them, it's this bond, by the way. For people who want to be paid in April and October, it's this bond. But that bond has not been on the primary market in over 2 years. And its interest rate is so bad right now. If we come back here, give me a second, let me resign in. Okay. So that bond there, its interest rate is this. Let me do year to date. Its interest rate when you are to buy it, actually, let me do price history here. It will be much better for people. You can see it's the bid that the banks will ask you for you to sell it will be 16.3. And if you are to look at it, if I'm to work it for you here, is to say here, for example, when is it maturing? Give me a second. It's maturing 3rd April 2031. What is its coupon rate? 17. So if you go to buy it and the bank tells you we want 16% and you want to buy it for 20 million, of course you're going to get a bond that is paying you in April and October. But you can see, I'll take this to hide away the confusion, and I'll make this bigger. You know, you're going to end up paying 22 million. That means you are paying a premium of 2.1 million that you're not even going to recover when it pays a coupon. So then you have to ask yourself, is it worth it, or should I play the long-term game? Long-term game means let me wait for the 2 year when that bond will come back on the primary market, because the Bank of Uganda also knows it has to stagger them. It will come. So do not rush to be like, oh, I want a bond that pays me in October or in April, and you end up paying a higher price. I'll give you another example. Let's use this one here, this 15-year bond. It's now 12 years. If you are to buy that bond on the secondary market, because there are certain bonds you can only get them on the secondary market. There are certain bonds which you can only get them on the secondary market. Then you have to ask yourself, what is the interest rate right now that is going on them? Then you come here, and its coupon rate is 16%. And then a bank tells you, and that client of mine, she was given 16%. And she was like, oh, I'm getting a very good rate. Should I buy? I'm like, what are you trying to buy? The bank has offered me 16% interest rate for this bond that's going to pay me in May and in November. And then I'm like, okay, It's not about the interest rate. It's also about what you're going to end up paying. That means she was going to pay a premium of around 2.1 million. So if interest rate reaches even 15%, then you end up paying a premium of 4.9. That might be a not a good investment decision, especially given the alignment of your goals. But if you are strongly convicted that you must buy a bond that pays in May and in November and you want it right now, of course it's okay to pay a little bit of a higher price. But you have to ask yourself, is it worth it? If I'm being given 16%, should I celebrate that it's a good thing? Or is there is something hidden behind it? You know? So what is most important is if you want to ladder your bond, it's going to take time. You have to heavily build your portfolio over time. You have to stick into the treasury bond over time. I know I have a lot of questions that I have ignored. I know someone has asked, is it possible to sell the bond whenever I want? Guys, yes. Even if you have bought it today and tomorrow you want to sell it, yes. The caveat is this. If you are buying a bond, you have to be in a position to say, okay, how much am I paying? When you are paying, I'll demonstrate this using this pricing. Let's assume you go to the bank and you want to buy a bond right now at 16%. They tell you the price is 16%. You pay 22 million. So you paid 22 million. Then after 3 months, you're like, I need my money back. You go to the bank and the bank tells you, we are buying it at 16.4. So now the bank ends up giving you so you have made a loss of 300k, which means every time you are buying a bond, be careful. It goes back to the other statement I said in our presentation. Try not to sell your bond when interest rates are going up. It means the price of it goes down. So for those of you who will be like, yes, you can sell your bond anytime. And I highly recommend that when you buy a bond, for as long as you hold it for more than 1 year, you will never make a loss. Because when you hold it for more than 1 year, it means it's going to pay you 2 coupons. By the time you sell it, it would have already paid you some money. So you're not making a loss. For those of you who are right now asking, if I'm to buy a bond, can I sell it? Yes, you can sell it anytime, anywhere. That is very, very important. You can sell it to any bank whatsoever. You want your money today, tomorrow the money will be on your bank account and the bank will take back the money. Which brings me back to the question which was very important. Now we go into the biggest questions, which is the risk. I need to go back to the presentation. There are two things. Someone asked the buying bonds that every single now and then to compound. The best way you can know how best to compound, there are two strategies. Let me actually explain a little bit on this. Let's assume you buy this bond, this one, the 20-year bond, which we have shown you here. You buy it for 10 million, and every 6 months it gives you this money, right? Every time it gives you that money, you can get this money and go and buy another bond. You can buy that exact treasury bond or another bond. What that means is, how do I demonstrate it? Okay, let me present another Excel that I was trying to avoid. Give me a second. Okay, where is it? There is a document I'm trying to get for you. Apologies, give me a second and I get your document, which I mean by that compounding. Come on, come on. I have so many documents, so it's not easy. Of discounted cash flow. No. Okay, I'm going to look for it and I come for it. But let me first go through the risks, and I've asked someone to get it for me. Let me first go through the risks. The first risk is what people talk about, the inflation or loss of value of our currency. If you have noticed this for the last, since 2020, 2018, this is the interest rate, the inflation around maximum it has ever been is 6%. Now, inflation, unfortunately, it's the only thing that impacts all of us at the same time. It impacts the bond investors, it impacts the land investors, business investors, all of us. So you are not safe to say that because me I'm invested in land, I'm not impacted by inflation. Inflation means a million worth today, how much is it worth tomorrow? So everything that you invest in, the goal is to make sure the amount of money you make from it is much more than the inflation. Now, I've demonstrated to you on here, if I'm to use the chart here, right? And I can make this monthly such that you can see it clearly. Oh, monthly is terrible. Weekly, right? I've demonstrated to you that interest rates in Uganda have always been above 15%. So that means for as long as interest rates are over and above the inflation rate, your money is making more money than it is losing straight away. Your money is making more money than it's losing. And that's where the benefit of investments in bonds are. Your goal is to say, how do I make money from this? Is to say, okay, I need to be in a position that every time I'm buying a bond, that bond has a higher interest rate than the inflation. Now in Uganda, it's the one of the few countries where inflation rate has been, it's not good. Let me not speak so much highly of the government, but it has been better. Now, if you're getting a 16% interest rate and inflation is 5%, it means you're making a 10% investment. So you are not losing any money. Now that's the benefit of investment. I don't know if that makes sense. So if you are making an investment, Your goal is to say, okay, where is the benefit I'm making? I'm buying a 15-year bond at 16%. As long as inflation is below 8%, I'm making a profit of 8% real return. But the good thing but the bad thing with inflation, it impacts all of us. It impacts all of us the same way. So it's not like, okay, the people who are in bonds or cash, even land, when you buy land at 10 million and in 10 years it's 100 million, you have to ask what has been the inflation factor for that. Which brings me to the question people always ask, and it's a very interesting question, which of the question of what about what happens to if they are to reduce, like what happened in Uganda in 1987? That is a loss of value. So let's assume we wake up and the government of the day comes and it says, okay, after 10 years, 1 million is worth 100,000. Of course, that erodes the value of the currency figure. But that impacts everything. It's an economic concept that your bond that has been 1 million is now worth 100,000. Your land that has been worth 1 million is worth 100,000. Your car that has been worth 1 million is worth 100,000. Those structural adjustments do not necessarily happen often, but they do happen, right? So it's a question of where you have to sit back and be like, do I have how, if it is to happen, am I impacted? How? It will affect all of us. Then the other significant question is the political risk. Let me present this document here. The political risk and the government not paying you. I think that's the biggest question which people always ask. When you are government, you have to ask yourself, who holds the biggest portfolio of my bonds? This is a report by government of Uganda. If you have your money in your bank, the commercial banks own the biggest portfolio of bonds. If you have money in pension funds, NSSF owns a lot of money in the treasury bonds. Bank of Uganda and external investors, plus insurance companies. Then the question becomes, then what happens if the government is to default? What are the chances that the government is going to default? If they are to default, all of us are impacted. Whether you have money in a bank account, it's gone. Whether you have NSSF, it's also gone. Whether you have money in the insurance company, the unit trust, come back to this, you can see the unit trusts here. They are all invested in treasury bond, it's gone. Now, can the government or the people who run this, can they allow that to happen? No. This is our insurance, by the way. That the catastrophic impact of, even if we are to get the worst of a dictator, I'm not going to downplay the politics in our country. There is a reason why since 1969, there has never been a default. Because the foundation of our country right now, the financial foundation, is on treasury bonds. They cannot default. Because almost the money will get, if we are to open any bank right now, I sometimes do not want to do this, but it's for demonstration purposes. So this is the Uganda one. This is live data set, so which you can look at. Stanbic Bank is the biggest bank. It's one of they call it a systematically important bank, like DFC, like all the other banks. When you come down to balance sheet, you have a total deposit of, let's say, customers' deposits of 6 trillion by December 31st. The cash it has is of 450. Where is the rest of the money? It's in loans and bonds. So to default Kakande, they have to default to Stanbic. To default to Stanbic, they have to default, Stanbic defaults to 1 million depositors. To default to Prim is to default not to pay NSSF. Not to pay NSSF is not to NSSF can't pay 2 million pension providers. To default Joan is to default to Old Mutual. You default Old Mutual, you're defaulting 100 plus people who have their investment in Old Mutual. So you do not, it's one of those where you sit back and be like, okay, because the big guys are heavily invested, the government understands the risk. And there has never been a default. There has never been a default. And which brings me to this document. Now, for those of you who are interested in this default, what would happen? This is something which I would want people to take a time and read through. Even when people talk about there is a default in Ghana, there was a default in Niger and everything, this tells you what happens when the default happens with the different countries. Like, for example, I violated Zambia in 2020. They paused the payment for 3 months and then they resumed paying. In the economic world, that is a default, but they pay back. So I don't want you to sit back. A government doesn't default like the way Kakande will default. When Kakande defaults, I just block you and I disappear because you lent me 1 million. Our friendship is gone. The government of the day, you are not lending to the president, you are lending to the government, the state. They have been doing this for the last 40 plus years. There is a reason that why the treasury bonds are managed at Bank of Uganda, one of the organizations with one of the most highly competent people in this country. They know what is at stake if even a single default is to happen. And to even stretch it further, and this is my assessment, to stretch it further is to tell you there is a reason why when the budget is being passed, they say treasury bonds and treasury bills payments is order number 1. So is there a risk of default? Yes. How material is it? To me, to Kakande's assessment, is limited. Now I go back to the question which people were asking about of compounding. This is the Excel. I don't think I shared this. Let's assume, and this is where I wanted people to understand the concept of compounding. I'm going to walk through it slowly by slowly and for people to understand it. Give me a second and I put in some fuel. Put in some chocolate. So let's assume you start with 10 million. I know the color red might make it a little bit terrible. Yeah. And we are talking about day 1. I can even first talk out this one. It means I'll use, let me use a higher figure such that it gives me the compounding numbers that I want. This bond that you buy, it's bond 1. It is going to be giving you 3.5 million every single time, every 6 months. I'll make it bigger. Thank you. See, 3.5 million. In year 1, so let's assume this is Jan and March 2025. Come on. I'll do March 2025. Okay. That bond is going to give you a coupon in July 2025 of 3.5 million. If you get all that money and you buy a bond, another bond, it means now you have two bonds. You have the first bond here and the second bond there. Now, if you end up buying the exact bond, which let's say it's the 20-year bond, and you go and buy it exactly, it means the next time it pays a coupon in Jan 2026, the coupon you're going to get is going to be 3.5 plus 100 to get a 3.46. Why? Because now you have two bonds. The first bond is going to continue bringing in the 3.25, and the second bond is going to give you the 200, and then you'll end up getting 3.4. Then in January 2026, you buy another bond of 3.46. Now all of a sudden you have three bonds. You have bond 1, bond 2, and bond 3. Then we go to July 2026. July 2026, the original bond will still give you the 3.5. The July 2025 will give you a coupon. The January 2026 will also give you a coupon. So by July 2026, you are earning 3 times. So all of a sudden now, you have seen originally you are earning 3.2, now you're earning 3.6 million. Now, someone who started with a bond of 50 million, now they have 50, they have 3.2, 3.46, and 3.6. They have a total of 60 million in a space of 16 months. Then we go to Jan 27. Jan 2027, the original bond, bond 1, will continue giving you the money you want, you gave in. Okay, that's ugly. Whatever. The second bond of 3.5, remember you used the money of the coupon to bring in that. The third bond, which was this and this, which added up here, it will bring you that. This will bring you that. Then you end up getting a 3.9. So by July 2027, by Jan 2027, which will be 24 months later, you would have 1, 2, 3, 4, 5 bonds. How? All you have used is the coupons you are getting to generate more money. And that's why you see the income you're starting to make is now more and more. Now to other people, they will be like, I will always, every time I get a coupon, I will always add in an extra 2 million. So let's assume you start with 5 million here. But every single time they give you a coupon, you get an extra 2 million and add it there. I'll stop it there. It means the first coupon of 500, it will give you a coupon of 320. But it's going to give it to you in July 2025, which is 4 months from now. At that point, it finds the 320 comes and it finds you with some 2 million you have already saved and ready to invest. Now you invest the 2.3 million. Then you go back and do your stuff. Then in Jan, the first coupon still gives you the 325. The second gives you the 150, but it finds you in January 2026 with a 2 million somewhere. Then you invest the 2.4. You continue doing your stuff. Then in July 2026, the same. So you build up the compounding one step at a time. What this means is that every time you get a coupon income, you put it back into the bond world and make money. That's what the concept of compounding means. And I know we had a little bit of certain questions around that, you know. I missed quite a few questions, but I'm going to try to go through and explain some of them. How about if I stop compound? Can I start? When you stop compounding, it's upon you. You can get your money and start using it for whatever reasons. Which brings me to this Excel that everyone has. 2 months ago, I had a client of mine. They wanted to invest in the bonds. They had close to 100 million. And their goal was to buy a house in 5 years, right? So we came up and said, okay, and I'm using big figures, but I'm going to use smaller figures to see. You do your 100 million here. Every single month, add in the 500K. By 2035 here, your bond portfolio would have grown to 350. At that point, you can withdraw the money. Even if you withdraw 300 and go do your plans, at that point, you can withdraw, go buy your house, and the other bonds continue making you money. It's okay. Compounding helps you to grow your money faster. It doesn't stop you from accessing your money. You might come up, this Excel that you have, the treasury bond tracking yearly, will be very helpful. You can sit back and be like, I'll put in 1 million every single minute. But at one point, you might want to withdraw. Withdraw some, let the rest of it continue to go. You cannot do it automatically. No, banks don't do it yet. I hope the system Bank of Uganda is developing will have that ability. But for now, you cannot. Can someone in Europe, if you have a bank account, yes, you can invest in Uganda. If you don't have a bank account in Uganda and you are a foreigner, you still can invest for as long as you can open up a bank account. There are some banks right now that are embracing that, where they are bringing in foreigners and you fill up the forms. Someone who says when you are buying a bond when it's about to pay coupon, it's a very good phenomenon. I'll use the 5-year bond. I'll take it as back to 10 days ago. Yes. It came out at 16.2. This 5-year bond paid a coupon on 27th. You can see it here. So when someone buys a bond when it's about to pay coupon, you have to see. So, and this is, thank you so much for this question. It's for people who are playing in the bond world, it's a cash flow element. It's something which people always want to play with, to say, okay, I'm paying 225 million. I know I'm getting a bond of 250, so I'm paying a premium of 230K. But I know in 3 days I'm going to be paid 1.6 million. Is it worth it? Yes. Because it means in one week, you would have made a profit of 1.3 million. So it's worth it. So I actually, most times when I'm writing about bonds, I tell people this bond is about to pay coupon. If you have some money, you can buy this bond because it means you are going to invest your money quickly, and in like less than a month, you have a return. Opening your CSD account, it's not hard. All you have to do is to go to any bank account, any bank that you want. Let me actually opening. This is the form. I'm not sure if I shared this. It's a 2-pager form when you're opening up a bank account. Very easy. Very, very easy to fill up. So you go to the bank or reach out to your bank online, they will easily give it to you. Then someone is asking, what is the meaning of a new bond? Every single year, there are 2 things that can happen. When the Bank of Uganda with the Treasury Department, they issue what we call the bond calendar. they can bring back a bond that they issued way before and they stopped issuing it. That's called reopening of a bond. Or they can bring an entirely new bond. An entirely new bond, it means no one who has it. It will first auction the day Bank of Uganda will say, and we noticed it this year. The 15-year bond, the one which is on the market right now, was first issued in July. Yet these other bonds, the 20-year bonds, 10-year bonds, have been there before. So that's what it means. Is it possible to open up a CSD account when you're outside of the country? Yes, it's possible. Where can you access the yield to maturity before the auction? Unfortunately, you can't. You can only know the yield to maturity on the day or after the auction. That's why it's called the auction. But if you are buying from the secondary market, the banks will give it to you. They will tell you the yield we are selling you this bond is this. The goal is for you to learn how to interpret that. What is the effect of buying a bond which is about to shut down? I know you are talking about Stanbic Bank, Standard Chartered. There is no effect. Now, let me talk about this. When you open up your CSD account, you are opening it with the Bank of Uganda. Your bonds are not held with your commercial bank. Your bonds are held with the Bank of Uganda. Now, the risk is if Bank of Uganda is shutting it down, which many of us who can agree it's not. So no matter what, whatever happens with the bank, that's why there are controls. The banking system is one of the highly regulated bank system in the globally. Even if the bank is closing down, those accounts will be transferred to another bank. What happened to Crane Bank that ended up being transferred to DFCU? So anyone who had a treasury bond with Crane Bank, their bonds continued and it moved to DFCU. So there is no risk whatsoever. Can a bond, especially the long-term ones, have a next of kin? Yes. So it's the next of kin, you put it on your bank account. You can say this bank account, my beneficiaries is my son or my wife or so and so. And that means whatever benefits that come from that account, which means even the bond, automatically go to their person. Can I sell my bond before maturity? I've talked about that. The people who earn 1 million, your best benefit is in here. Start with, to buy a bond, all you need is less than 1 million, it's 100K. Just start with 1 million and just commit to every single month to deposit 100K and stay the course. What I mean is stay the course, allow your bonds to compound. Allow your bonds to compound every single day. That means you keep buying. One day, you started with 1 million, you're going to wake up 66 million. If you start with around, let's say, 300,000, right? It will grow. Whatever money you have there, it will grow. No, Arnold, that is not true. For as long as you have like I said, let me go back to the statement I said. If you have little amount, like 100,000, 200,000, just buy from the secondary market. They will not charge you any cost. The secondary market, you don't pay the bank. You're buying from the bank. But even if you do not want to do that, this is the strategy you can do. Let's go back to the unit trust. You can say, I have 100,000. And you accumulate every single year, every single month, and every time it reaches 1 million, you go buy a bond. Very good strategy. Every month, 1 million. Every month, 100,000. After a year, you have 1 million, you go buy a bond. Very, very good strategy. You will compound. your bonds. Where do I deposit the money when I'm buying a bond? On your bank account. You just put it on your bank account. When you fill up the form, it will automatically go. Shamim, can I withdraw the profits? Yes, those profits come to your bank. They come to your bank account. You can withdraw and eat it or spend it, whatever you want to do. So your goal is to always say, what is my plan? Do I need to buy more? Or do I need to buy to use the money? When you use the money, you are eating out what would have compounded. If you don't eat out the money, the profits you're going to make in the future are going to grow. Can you buy bonds from 2 different accounts from different banks? Yes. Even if you have 5 bank accounts, those are different CSDs. Jointly, yes. Can you buy it as a company? Yes. Everything. Should I consolidate my monthly top-ups? Depending. Personally, if you have more than a million or 500, I would say keep buying. To other people, they like, okay, it's too much to fill up the forms. I will always consolidate on a unit trust every 6 months. That's when I go and buy. So I'm okay with that. So the questions of people who are asking how they can access me, my WhatsApp number is put it on my mat, but you have my email. We can engage there. But I know I'm almost over and above. I'm trying to address now the questions that are coming in, possibly. Can you link a CSD from one account to another? Unfortunately not. You have to open up a CSD account in another bank and you do a bank transfer. You remember what we talked about here, a transfer? A transfer means you're transferring a bond from one CSD to another for free. So let's assume you were in bank A, you want to go to bank B, you just fill up these forms, take them to the different banks, they will transfer it to the other bank. Nita, you are asking about primary versus secondary. The primary market is when you are buying from Bank of Uganda. The secondary market is when you are buying from commercial banks or anyone else. Apologies. If at auction is the yield to maturity is not favorable, no, you cannot get out of it. Unfortunately, there is a way you can do it, but it's not something I would recommend. You can do it by not paying, by making sure the bank account doesn't have money. It means it won't go there, but it's not recommended. Because when you do it consistently for 3 times, I think there is a way they suspend your account because it means they allocate to your bond and you don't take advantage of it. Okay, I think I've gone through majority of the questions. And I know I cannot exhaust most of the questions. Unit trusts, treasury bills, and treasury bonds. If you want to make more money, you make more money in treasury bonds, not in treasury bills. The unit trust can be a very good component for anyone. So I highly recommend them. Yes, it's going to be recorded and I'll be sharing the link later in the night or tomorrow morning. Otherwise, I know I can't exhaust all the questions and everything. We shall do another session potentially. Prim will let us know in maybe 6 months from now and do another session or quarterly like someone has what. But I want to thank you so much. I can see most of the questions coming in, but I cannot address all of them. Thank you so much, everyone. Have a good night.